emerging market economies all eventually hit the same mathematical wall. They need massive amounts of capital to build modern infrastructure, deep-water ports, high-speed rail, tech corridors. But borrowing heavily to fund it risks triggering a sovereign debt crisis. Vietnam has spent the last 2 decades transforming into a deeply integrated manufacturing hub for Southeast Asia, but sustaining that economic growth requires an infrastructure upgrade that the state cannot easily afford on its own. The traditional frontier playbook relies on heavy state borrowing and international aid. Eventually, the interest payments crowd out actual development, and the model breaks. To prevent that scenario, the Vietnamese Prime Minister issued Decision 368. This document is the formal financial strategy guiding the country through 2030. Decision 368 functions as a rigid structural engineering document, prioritizing the capping of state leverage over traditional expansionary spending. The state is effectively signaling that it will step back from being the sole financier of growth, shifting the burden of capital formation onto modernized, deeply integrated private financial markets. This dashboard illustrates the 3 vectors required to achieve this transition: a complete restructuring of the fiscal budget, a massive expansion of private market capitalization, and the deployment of digital infrastructure to enforce the system. Every policy in this strategy is dictated by one master constraint. The state has mandated a hard limit on sovereign borrowing, capping public debt at exactly 60% of GDP. Locking public debt at that ceiling removes the government's ability to borrow its way out of trouble. It forces a complete, ground-up redesign of how the state collects revenue, manages operational spending, and enforces tax compliance. Look closely at Section 3.a of the decision. It reveals a strict top-line revenue boundary, capping budget mobilization at 16 to 17% of GDP for the 2026 to 2030 period. In the Vietnamese context, state budget mobilization represents the total percentage of the economy the government extracts through taxes, fees, and charges. They are intentionally keeping their own revenue boundary narrow. If the state refuses to borrow past 60% of GDP and refuses to tax past 17% of GDP, the math dictates that any new capital for infrastructure has to come from cutting existing internal operating costs. This flowchart demonstrates the internal tension. The government's fixed revenue pool must be divided between daily operational costs and long-term development investment, which the strategy mandates must expand to 29% by 2025. To mathematically balance that expansion, the document orders exact cuts to operating costs, compressing recurrent expenditure down to 60%. Compressing operating costs to that level requires shrinking the administrative state. It forces public units into financial autonomy and demands total civil service efficiency. Even with those internal cuts, the ultimate macroeconomic guardrail remains. The resulting budget deficit must be aggressively compressed down to a strict 3% of GDP by 2030. This fiscal straitjacket intentionally prevents the government from single-handedly funding the nation's transition into the Fourth Industrial Revolution. If state development spending is mathematically constrained, where is the massive capital for modernization actually originating? This dashboard highlights the text's explicit solution: forced, rapid expansion of private financial markets. The domestic stock market capitalization must reach 120% of GDP by 2030, while the bond market must hit 58%. Scaling a stock market to 120% of GDP in a single decade requires injecting massive volumes of new equity directly into the public exchanges. Section 5 outlines the designated mechanism for this injection: the accelerated equitization and divestment of state-owned enterprises. The state is ordered to sell off its corporate holdings and list them publicly. To absorb that much newly listed state equity, domestic retail investors won't be enough. The market requires foreign institutional capital, but global funds will not commit billions without standardized financial transparency. That is why the strategy makes the transition to International Financial Reporting Standards, or IFRS, mandatory. It is the strict institutional prerequisite required to attract foreign capital. Capital markets are now the officially designated engines meant to replace sovereign debt as the primary growth vehicle for the country. There is one glaring vulnerability in this system. How does the nation maintain a stable, predictable revenue stream to fund operations without raising tax rates, especially during economic disruption? The strategy relies heavily on digital compliance, broadening the tax base by targeting sectors that traditionally leak revenue, specifically e-commerce and the digital economy. The document mandates the elimination of fragmented paper systems, ordering the construction of a unified digital state budget and accounting information system known as VD-BAS. VD-BAS represents real-time algorithmic oversight of all state cash flows, instantly flagging macro-fiscal risks before they materialize. This modernization requirement runs parallel at the borders. The strategy dictates the immediate rollout of digital customs and smart customs frameworks. By deploying big data at ports of entry, these digital checkpoints act as a direct hedge against tax evasion and trade fraud, ensuring import and export revenues are secured. Furthermore, the strategy explicitly integrates artificial intelligence and cloud computing to link this national financial data with broader ASEAN regional networks. Integrated data architecture and AI function as the primary fiscal instruments required to enforce the mathematical constraints established throughout the document. Zooming out to view the entire engineered system, the three pillars, fiscal limits, market expansion, and digital enforcement, are entirely codependent. Digital enforcement captures the tax base and stabilizes the 16% revenue cap. This allows the state to compress the deficit and hold debt strictly below 60%. Because state debt is capped, IFRS-compliant capital markets must expand to fund the remaining infrastructure gap. The ultimate objective of Decision 368 is the permanent transition from a frontier, state-heavy model to a modernized, market-driven economy. This model systematically reduces reliance on traditional official development assistance in favor of building deep, mature domestic debt markets. The primary risk is the unforgiving 2030 deadline. Hitting these targets demands an extreme pace of institutional and transparency reform. The next decade of Vietnamese economic growth will not be determined by how much capital the government can borrow. It will be determined by how ruthlessly it can execute on these structural mandates.